This is Tom Clay with my bi-monthly precious metals market update. It's been a hodgepodge today. I mean, it's been a very good week for me, a great week here, rainy day in Georgia. Videoing this right now. And my son turned 50 yesterday. It really makes you feel old, but I still got plenty of time here to work and continue to follow these markets. I've followed closely for 48 years, and I think of all the relationships I've built. Last week, we had a client come down that since 1981, and he was in his 70s and retiring, and went over all the places we've been with just a little part of the portfolio he's had in gold and silver and precious metals, and what it's done over the lifetime, and where this country's gone, and where is this country going. These are questions that we all ask and want to ask every day, but I've never seen this country more divided. In my career, I've never seen as much time needed to study and to figure out what's going on out there, because it's just, it's where it's going now, not where it's been. We got to look out and see where it's going. So what I'm going to do is just questions that come in through the email, and then people that called, I've talked to, but I want to touch on a couple of subjects today. The first is gold has to be and is the safest place you can put your money. And we have never advocated big percentages of anything, including stocks and bonds, in a portfolio. It was meant to be divided and diversifying your money into different baskets, so to say, to help you take advantage if something goes the wrong way from what you thought. But this time, the last year and a half, you've been given a lifetime opportunity. And if you haven't bought gold, you've made a serious mistake. And if you don't buy it the next 18 months, you're going to make another serious mistake, because it's going to go a lot higher. We've been telling you for 2 years, once Basel III started and central banks started buying gold, you're going to see some big returns, but that's not what you're going in for. You're going in to have something that's accepted anywhere in the world, something that's not somebody else's debt, something you can't create out of thin air, something that's bad when you have an asset like that you're not using it to your advantage. So what I say to you first, and what I say every day when I talk to somebody, I don't care if you're worth, this guy the other day was worth $16 million. I don't care if you're worth 16 million or 6 million or 600,000. You need to have a percentage in gold, not an amount, a percentage, and look at it, because it's different for every person. But I can only tell you from 48 years experience of doing this, we are in an opportunity. Even though you say we went up 13% last year in the first year of Basel III, we're already up 5% this year. We're going to keep seeing double-digit returns. And I just can't tell you enough how bad you need to have part of your money in that. And then my pet peeve, even though they send me millions of dollars of business, are financial advisors. Here's somebody out talking about fiduciary responsibilities, and they're not in gold. That would be the first thing, not the last thing you would be in. Just look at it from a biblical perspective. Look at it from a standpoint of not even existed when they started printing money. It's just a debt that'll never be paid. So at some point it'll be reset, and we can get a little bit of that in a minute. But anyway, I want to visit again the usdebtclock.org. Let me say it again, usdebtclock.org. By spending 30 minutes looking at that, you can figure about everything you need to know. Look at the bottom right-hand corner and look where really gold and silver is worth. Not what you're buying it for at huge discounted prices right now. Huge discounted prices. But look at it, please, and look at it with the new boy on the block that, I remember when the word trillion came out, I couldn't even comprehend $1 trillion. That was 1,000 billion. I couldn't even comprehend it. And now the new word is quadrillion. Quadrillion. And where does the quadrillion come from? It comes from the giant. The giant is unfunded liabilities. We're worried about debt right now, runaway interest, over $1 trillion off the federal debt deficit of 34 trillion times 3%, the average interest rate in securities. And you're talking about $1 trillion in interest in 1 year. We're talking about interest. It has nothing to do with the amount. The 34 trillion is growing, and you throw in $1 trillion of interest, and there goes another trillion. And that is going to be for the foreseeable future. So please go and spend. As I looked this morning before that, the unfunded liabilities, those are what they owe me rest of my life expectancy. I may have 10 years more life expectancy. And they're going to owe me Social Security up through that. That's an unfunded liability they've set in, and they owe it to me, but they don't pay it until it needs paid or has to be paid. But now, this morning, it was 213 quadrillion, 446 trillion, 906 billion, 440 million, $400 of unfunded liabilities that have to be paid in the future. Where does this money come from? It's money by decree. It's made up. It's paper. It's nothing. When there's a scramble for a real sum that's believed in around the world, it's going to be gold and silver. There's no doubt about it. No doubt about it. But if for some reason people keep wanting to put their money into paper investments, that's fine. You should. But not the percentages that you are. And like I said, I talked to a money manager the other day, and he said, Tom, I followed you for 20-something years. He said, it's finally gotten through. He said, I looked at it from a selfish perspective. He said, I wasn't getting any payment. If I put somebody into gold, I didn't make anything out of it. I was taking money out because I get paid as an investment advisor. But a lot of them now are sending me and saying, you buy your metals from Cloud. He knows what he's doing. He's got the best price out there, and he's used to dealing with money managers and talking finances. That's what his background's in. So yeah, I do have propensity toward that gold, even over since 1973, silver, they've been very comparable in return. But you've had none in gold. And just look at 2007, 8, 9, when gold was the only investment that went up in an index, period. Stocks didn't go up, they went down 38%. Gold went up like 8%. It wasn't that gold went up a lot, it was the only thing that went up. But just remember to look at the unfunded liabilities, usdebtclock.org. Talk a little bit in the news this week. Clients saw that the BRICS is back alive and well. Of course, BRICS we know is originally China, Russia, Turkey, India, Argentina, these different countries that are getting together to have a currency. Well, now we find out just in the last few days that they now are more than doubled. The new countries adding to BRICS are Egypt, Ethiopia, Iran, Saudi Arabia, and Arab Emirates. All these are now coming together, and Kenya, which by itself is a nothing. But Kenya, with another 50 to 100 small countries taking their trade transactions in a new BRICS currency, could set the dollar into a tailspin. And the dollar, we know right now, we've watched it come from 123 down to 103. And when it goes below 103, I've talked about it many times. Every 1% it goes below 103, 100. You're going to see 2% up for gold. And that's the reason you see this week more people talking about 3,000. I mean, we're at 2150 right now. Another 30%, and you're at 3,000. Yes, I do think we'll see it this year. It's an election year. Election year has been real good to gold and silver. You let them print money now and talk about it later after the new agenda comes in. Nothing good to look at out there. So what we're saying right now is do your asset allocation. Do it where gold is the center part of it. It has to be. If you're not, you're going to be leaving the main investment that's going into the world. It's going to be accepted. And remember, what do central banks know that you don't know? They know where gold's going. That's the reason they're buying it. If you're not buying and following them, you're making a mistake. I may be over-advocating gold today, but that's the way I feel. That's the way I've seen it over and over. And never more than right now am I looking at it in that view. So hopefully you'll get that, but just remember, if you don't have gold with your money manager, we're not talking about going and getting gold ETFs. That's paper gold. You need real gold. That's where the benefit's going to be. That's where the premium's going to be above spot, where you can sell it when the rainy days really come and people around the world quit accepting the US dollar. That is absolutely inevitable. You've got to dig into this and protect your family. As I look at my children and grandchildren, I got one a senior in college, a grandchild, one that's just turned 22, and she's trying the movie business out in California. And you look at all these things that you see going on, and you look at a lifetime of work, a lifetime of being of service to people, not always being right, but I've tried to shoot straight with you during all these years. I've always appreciated both the criticisms and the thank yous. It's there. I just feel that's important to say because it's right now more important than ever. A fiduciary responsibility includes gold. Without it, it's not a fiduciary. It's not if you're not dividing up. And a lot of advisors don't like that because once again, I'm saying something that they don't get paid on if their client does what's best for the client. So anyway, I hope I've touched on some nerves today, and I, certainly thank you for the emails and the questions, and we'll keep this going. But I tell you, when we don't have time to talk about it today, but silver is very close. We're at 90 to 1 gold times silver is 90 times more valuable. I've said over and over again, it's going to 100. So we're closing in on the last 10% where gold's going to go up faster than silver. And when this thing turns, where the little guy can't afford gold at $3,000, $4,000 an ounce, but he can afford silver at $25 to $30 an ounce and drive it. Because remember, silver's been to $50 2 times since I've been in business. And this next time it's going to go way past 50. So right now it's sitting at 23.50, saying it's going to double to get to 47, 48. But going to start buying it, but we'll get into more details soon on that because I have had some corresponding on why it's gold lagged behind gold so much. So anyway, if you need to get in touch with us, call us at 800-247-2812. 800-247-2812. If you don't have a precious metals IRA and your retirement age in your 60s and 70s, come out with your 401k and get you 2 self-directed IRAs. And Dan Scoggins in our office can help you where you have one for your gold and silver and precious metals and one for your stocks and bonds and money markets. So that way you have 2 self-directed IRAs and can diversify between them. So anyway, hope all this was helpful, and I'll look forward to seeing you in 2 weeks with this bi-monthly Precious Metals Market Update. This is Tom Cloud signing out.